Greetings traders and welcome back to today's video. We're diving into quarter theory, a concept that could seriously level up your trading. We'll break it down, show you how it works, and how you can start using it right away. But before we get into that, I'd like to take this opportunity to first sincerely apologize for the recent pause in content. I've been busy prepping my portfolio for potential architecture internship, right? So therefore I decided to take the month off and to focus primarily on architecture in order to work on my portfolio, and then soon after that to apply for a certain opportunity that I was looking forward to. But now all of that is done, so we can get back on track. Now, if you haven't yet, please do check out the previous videos in the high probability trading zones playlist. They'll give you the foundation you need to fully grasp what we're about to explore. For those watching on TradingView, I'll include links to the previous videos so that you can easily catch up as well. So now my thinking was that we'll kick off a weekly series focused primarily on quarter theory with the goal of building a solid trading model by the end. So let's get into it. Okay, cool. So in today's lecture, we'll be using slides, right? And you'll see that I made these slides on the 28th of June. And my thinking at the time was to release this video as a continuation of the two other videos in the high probability trading zones playlist, right? So you'll notice that those two other videos focus primarily on draw on liquidity or bias, right? So they help you to understand what or where the market is most likely going to draw to next. So now what quarter theory will allow us to do is that it will allow us to then act on that bias, right? You'll soon come to realize that quarter theory works best provided that you know where the market is most likely going to draw to next. Cool. And another thing that I'd like you guys to understand as well is that this is going to be it's going to be an introductory video to quarter theory, right? And because it's going to be an introductory video, what I've decided to do is I'm only going to be going through two time frames in today's video, which is going to be our weekly time frame, which will be our higher time frame, and we're going to be looking at that in relation to the hourly time frame. All right. And the reason why I chose the hourly time frame is because it's a time frame that a lot of traders use, right? A lot of swing traders and all of those sorts of things. So as the weeks unfold, we'll get to a point where we'll be studying our daily time frame against our M15 time frame, which will be for intraday traders, right? For intraday price action. And then there'll come a time as well where we'll be looking at our monthly time frame against our daily time frame, and that will be our more long-term perspective for position size traders. So at the moment, we're just looking at the weekly against the hourly, which is basically for swing traders, who tend to hold trades within a week, a weekly time span sort of a thing. Right. But now with that being said, let's get into it. Quarter theory. So what is quarter theory? It is the study of algorithmic price delivery within the market. The market is delivered or priced by an algorithm called IPDA, which is the interbank price delivery algorithm. Therefore, its patterns are repetitive and fractal. And what that gives us an understanding of is that the market is very definitive in its delivery, that it's not random, that it's only us as traders who perceive the market to be random, whereas it's not, right? Everything about the market is delivered intentionally. And so the idea of fractalness gives us the nature of the market itself, right? Fractal gives us this idea that you have different levels where you have the same thing occurring in those different levels or scales, or according to the market, different time frames. That on every different time frame, the same thing is recurring, right? And that also allows us to understand why it occurs. The nature of the market is the way it is because of two factors. And those factors are, firstly, price, which exists over here on the y axis. And so we're always looking at price in relation to time, on the x-axis. So these two things work together to then give us information, right, in form of a graph or candlesticks, right? That information is then, you know, in form of the narrative, or that information is either, where the market is bullish or bearish. That's the type of information that we get by relating these two. So now the relationship of these two then allows us to understand the time and price theory, which is based on the idea that the market can be predicted by analyzing the relationship between time and price. It suggests that significant price movements often occur at specific times and specific price levels. So that over there is the foundation itself of quarter theory. All right. So let's continue. So now we have a brief understanding of what quarter theory is, and then all of it is basically, you know, all of it exists because of an algorithm. And because there's an algorithm, we understand that the market is fractal, and we get to understand this time and price theory, and then we also get to understand that specific things occur at specific times and specific price levels. So that itself is quarter theory. So let's get into it. So we're going to be looking at the weekly time frame. This will represent our weekly time frame. And the understanding is that prior to this candle, we want to assume that the market has been bullish, right? And that this candle itself has not been established as of yet, and that we are anticipating that the candle will be a bullish close candle. So that will lead us into candlestick anatomy, where we'll understand the power of three as well. So how a candle is formed is that you have the open of the candle, in which this is the open of the weekly candle itself. If you're anticipating a bullish candle, what tends to occur is you will first see price push towards the downside as to establish the low of the candle, or the low of the week. Once the low has been established, you'll see a heavy distribution of price action towards the upside to set the high of the week, right? That is the power of three. You'll get the open of the candle, and then you'll get a manipulation of price action. You'll get a manipulation of price action towards the downside, and then you'll get a heavy distribution of price action as to set the high of the week. That is the power of three, and then eventually the candle closes. So we understand that the market itself is fractal. So we want to look at this candlestick in relation to the hourly time frame, right? So we want to see how this specific candle can unfold on the hourly time frame, and that's when we get into quarter theory. That's when we're studying the, you know, the characteristics of how the algorithm itself delivers this candlestick. And you'll soon come to understand that this same candlestick can be delivered in three ways, or three models. So we're looking at the first model, which is model one, which is called AMDX. Right. But before we get into that, the precondition is, and these are rules, of course, that you should note. When you go into the hourly time frame, what you firstly want to do is you want to separate the hourly time frame into its respective days, right? Meaning what? On Monday, 12 a.m. New York time, make sure that you're using New York time. You want to place a horizontal line on there. Have a 24-hour span until Tuesday, New York time, 12 a.m. New York time, right? And then you want to continue this until Friday. And then what you'll start to see is that Monday will be your first quarter. Then you'll have your second, your third, and your fourth. There is no fifth quarter, right? So Friday's quarter is non-existent, which is also which will also give you an indication that you do not trade Friday as well, because Friday has a different responsibility, right? The algorithm is focused on these 4 trading days. So those are the 4 trading days that you will be looking forward to, right? And that's how quarter theory works, right? Okay, cool. So we've established that an algorithm delivers price action. And if it's all just ones and zeros, that it's just a matrix on its own, the market. Therefore, there should be a code, right? Something, a fingerprint that can help you decipher the rest of the code. And that code itself, or that cheat code, is on Monday. Because of that, you need to understand that you never trade Monday. We understand that we have the open of the week, price trades. You never trade Monday. Monday is a no trade zone because of the fact that you want Q1 to play out so that you can decipher what Q1 did, right? How did price deliver? So the first question you want to ask yourself after Monday has been delivered is this. In this price action, did Monday produce a cumulative price action, or did it produce a trend-like type of price action? Of course, we're looking at model one. We can see that this is a cumulative price action. So you want to then note that Monday was a cumulative in nature, that is accumulation. What AMDX stands for is accumulation, manipulation, distribution, and then X is a continuation or reversal. Right. So now you've established that this is model one because Monday accumulated. All right. So what do you anticipate on Tuesday? You anticipate a manipulation, and then Wednesday a distribution, and then Thursday a continuation or reversal. Right. So the true open actually occurs on Tuesday. So you want to note that price. You have an open of the week, but you get the true open which occurs on Tuesday. So at 12 a.m. on Tuesday, you want to note that price. Right. You're anticipating a manipulation, right? So that manipulation will occur towards the downside because this is going to be an up close candle. That manipulation occurs and it's called the Judas swing. Why is it called the Judas swing? When ICT speaks about why he calls it the Judas swing, he says within a farm there is a sheep called Judas, and its job is to lead the other sheep into the slaughterhouse. But before the sheep goes into the slaughterhouse, the Judas sheep, right? It turns around and all the other sheep go into the slaughterhouse, right? That same narrative occurs within the markets. The algorithm or this price action towards the downside itself is that sheep leading us towards the slaughterhouse. Because we can see that price over here at a nice support, price break structure, you get a pullback over here, right? What are we doing as traders? We're selling this. We're continuously buying the support, right? But then we get manipulated out of price action. The algorithm does that on purpose to entice us. Why is it doing that? Because at these lows exist sell stops. These are sell stops or willing sellers at a discount price to buy against. That's what the algorithm is interested in, right? So you get the manipulation towards the downside. The manipulation takes out sell stops, etc., etc. That's the first thing it does. The second thing it does is that it sets the low of the week, right? Once the low of the week has been set, what you want to do is wait for a confirmation to occur over here and buy against everyone who's selling, right? Because people are continuously selling this. So you want to buy against that. So that's how the low of the week has been established. What do you anticipate after that? The distribution to set the high of the week. So you've bought this. Manipulation is where you trade. That is high probability. That's why it's denoted in green. Manipulation occurs, you've entered your order. Wednesday, you're anticipating D, the distribution of price action, meaning price is going to continue this move by distributing towards the upside, heavily so, as to set the high of the week. Once the high of the week has been set, the distribution phase is now finished when price closes over here. Then we move on to Thursday. Thursday has our continuation or reversal week. It can either continue what Wednesday did or it can reverse what Wednesday did, right? This one has a lighter green color. You can trade it, but it's less probable. These two should be what you focus on, highly focus on, right? And then once Thursday closes, that's the true close of the week. And then Friday does its thing, and then you get the close of the candle, right? So this model itself is AMDX. Remember, you wait for Monday to unfold. Monday will then tell you what the rest of the week will look like. Let's go on to the second model. Okay, we'll move a lot faster now. Same candle can now unfold in this manner. This is model 2, which is called XAMD. Right. Same thing, you get the open of the week. You let Monday play out. You never trade Monday. The first question you want to ask yourself is, after Monday has been played out, is was Monday accumulating in nature or was it trending in nature? right? Don't make it subjective. Study it, right? We will get into accumulations and stuff like that, how to properly, annotate accumulation and when it's not an accumulation. In this instance, this is not an accumulation. This is an X, a continuation or reversal of price action. So you denote it as that. So immediately you know that after that, you can either anticipate model 2 or model 3. Model 1 will not occur. So in this instance, model 2 on Tuesday forms an accumulation. So you wait that out. You don't trade that. So you understand that you will anticipate an accumulation. So which means Wednesday is your trading day because that's when you'll anticipate a manipulation of price action. That's when your Judas swing occurs. Your true open is still on Tuesday. Judas swing can either take out the sell stops resting down here, or it can go even lower to take out the sell stops resting there, set the low, and then continue towards the high. Do not cram it, or do not cram it. Just have an understanding of it. So the moment the Judas swing has occurred and you get a confirmation for price action to continue towards the upside, do so. So you'll see in this example, the low of the week was set on Monday, and then Thursday distributes higher towards the upside to set the high of the week. Thursday closes, that's a true open. Friday does its thing, and then you get the close over there. This model, however, hardly occurs. Only Model 3 and Model 1 tend to occur a large majority of the time. Let's go on to Model 3. Model 3. This one occurs, a large majority of the time. This one is the one you'll see occurring almost all the time. So the same candle, but unfolds differently. In this instance, you let Monday play out. Remember, no trade zone. After Monday's played out, ask the question, did it accumulate? Did it trend? This is not an accumulation. This is a trend in price action. Tuesday. If Tuesday in this instance happens to take out Monday's low, you can trade that provided that there's a confirmation to do so. But you'll see it's shaded in a lighter green, meaning it's low probability, right? So you wait for Wednesday to occur. Remember, Model 3 is XXMD. So you're trading, these two. Manipulation occurs. Remember, it can even go further to set the low, or it can just take a minor low. Judas swing, confirmation, price pushes towards the upside. Thursday continues that narrative by distributing to set the high of the week. And then Thursday closes, true close occurs, Friday does its thing, and then closes, right? This one occurs the most. This is Model 3. I also refer to it as Model X. I don't know. It just seemed cool to call it that, right? So this is the XXMD. Now let's go into practical examples. Okay, cool. So this is our weekly time frame, split in half. This is our hourly time frame, right? Same thing. In this instance, price had taken out buy stops over here, so I was anticipating, this weekly candle to be a down close candle, meaning I wanted it to set the high and then trade towards the downside. Eventually closed somewhere around there, right? So I want price to set the high and then push towards the downside. This is it, right? Hourly candle, the same thing, Q1 till Q4. Monday, I don't trade Monday. I let it play out. We will get into consolidations and how to properly, mark them. So in this instance, this was a consolidation for me, right? Because it continued as well into Q2. So that's my accumulation. Immediately, I understand that this is model 1. So what am I anticipating on Q2 to do? To set the high of the week by manipulating towards the upside. My confirmation occurs over there when I get the market structure shift. Heavy distribution lower, price comes back, taps into that order block. I put my sell order on there, SL on the high. What am I targeting? They're relatively equal lows resting down here, so liquidity is there, right? So I understand already this is, going to be a continuation. You can see price does pull back into a fair value gap over there. You can enter another sell order, SL on the high, target these relatively equal lows, and then it's done. So Thursday closes over there, and then Friday does its own thing. You can see that, right? Let's go into the next example. This is the next example. Yeah, I'm anticipating bearishness, a down close candle, right? So you can see in this instance, it unfolds as what? XXMD. This is not an accumulation of price action, right? And so you'll see manipulation occurs over there when it takes out those buy stops. You get market structure shift, and then price pushes towards the downside. But yeah, we will continue with this. With that being said,